Hi, this is Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share evidence-based holistic insights to help you master the game of building wealth. And before we get into today's episode, as promised in yesterday's episode, I'm very proud to announce that my new book, Wealth by Design, is available for pre-order. Books won't actually be delivered until the end of July, but you can certainly pre-order now, whether that's through Amazon or Booktopia or wherever you want to, buy books. The thing is that pre-orders matter more than they ever have, really. I mean, I think I published my first book probably 15 or more years ago, and the landscape's changed a lot. And now these days, bookstores and other online retailers really look at pre-order numbers to decide whether they're going to stock a book. So my publishers told me pre-orders really matter. It's the first time I've actually promoted a pre-order of a book that I've written. So if you're interested in it and you think it might be something you might want to look at, it would be of a amazing help to me if you pre-order it. If you're going to buy it anyway, maybe buy it now, even though you're not going to receive the book maybe for almost a couple of months. And as I announced at the beginning of this year, I've got a pre-order bonus. So there's a link in the show notes that you can follow to get that pre-order bonus. And the pre-order bonus is a Investopoly research assistant. So what we've done is we've put a AI tool plugin on our website. It only looks at all the blogs that I've written over the last 10, 15 years. So, there's over 700,000 words I've written. I can't believe it. And so if you're wondering what the answer to a particular question is, has Stuart written about this before? What's our viewpoint on this? You can use that tool and it will write you an answer and also give you the link to the most relevant blog or blogs. So you can use it as a bit of an education piece if you like. Also, with respect to the book, Wealth by Design, it's obviously a complete rewrite of Investopoly that I wrote more than 8 years ago. So a lot of thinking, analysis, more lessons, all these sorts of things that have occurred over the last 8 years, I've put into the book. And as I will typically approach these things, I'm not happy with an edit. I threw the entire book out and started again. And I think, Investopoly was version 1. Of course, this is version 2. He doesn't know it yet, but it's on Campbell to write version 3 maybe in another 8 years' time if he's up for the challenge. Because after I finish a book, in fact, I've written 2 this year, but after I finished a book, I always say never again. So anyway, who knows what the future holds. But I think it is a far sharper version of what I produced originally. So, it brings all the sort of strategy and approach and focus together in one place. The other challenge with writing Wealth by Design is it will be released internationally. So I couldn't talk about, superannuation and particular tax rules in Australia, which is okay because I talk about them a lot in the podcast. But what it did is it forced me to be even clearer, I guess, on strategy decisions, without the Australian nuance or so forth. So actually, I thought it was going to be difficult to write a book like that, but actually looking back at it, I think because of it, it's a more powerful book. And lastly, what I want to talk about is that I built using Notebook LM, which is a Google tool, and I've almost finished the tool and I've been in sort of testing phase, but it's a tool that's trained on the book's contents. And so anyone that buys the book will have access to this Notebook LM tool. And it will really help readers get even more value from the tool. So you can query it and ask questions and ask it to explain chapter 1's concepts more clearly to me or something like that. So, or if there's something, a particular part of a chapter that you need explained differently, you can do that. You can tell it about your circumstances and ask it to apply the methodologies and concepts in the book, to your situation and ask what should your next step be, for instance. It's not going to give you personalized advice, of course. It is only information like a book. But I think one of the challenges with books is that you learn so much, but how do you apply it to your particular circumstances? Well, this AI tool is going to help you do that. And then lastly, you can get it to write a prompt for you that you can then paste into another AI tool. So that's where you can actually apply the more jurisdictional considerations. So for example, you can ask the Notebook LM tool to write you a prompt that will look at a particular property and address of a property and use a checklist based on the fundamentals and the concepts and the strategies explained in Wealth by Design. And then you can paste that into another AI tool, and using those concepts, it'll apply it to a specific property. Now, again, there's limitations with these sorts of tools. I'm not saying it's going to be a magic wand. What I'm saying is that what it will do is help you apply the concepts in the book to your specific circumstances and specific assets and specific situations. It's not a replacement for personalized advice. So I don't want to hold it out to say you must, it's so good you can rely on it. Of course, you need that healthy level of skepticism that these tools aren't the be all and end all, but I think they will greatly improve the value from a book. So I know it's a big sales pitch, but I really wanted to be really clear around how this book is different. And as I said, it would be, the pre-sales data makes a big difference. And we really do want to get these books into bookstores and in front of as many people as possible. And so, look, I appreciate the community. I appreciate the support that everyone has given me since starting this podcast. And I've got a lot of loyal listeners that I'm forever grateful for. So I appreciate it. And if there's one thing that you could do for me, would be certainly talk about the book to anyone that you think would benefit from reading it. And if you're interested in buying it and you plan on buying it, please pre-order it. I've got the link in the show notes, as I said. It's on Amazon, Booktopia. I haven't looked at any other online websites, but I'm sure it's on more websites than that. But that'd be a great help. Okay, enough of this self-promotion, I hear you think. Yes, let's move on in today's episode. And today I want to talk about Charlie Munger's investing checklist. It's not the usual sort of episode that I like to produce because I really pride myself on bringing unique and thoughtful content to this podcast. So picking up someone else's checklist of items certainly isn't in line with that. But I did read the checklist of 10 investment principles, I guess, that he put together, that Charlie Munger put together, and it really resonated. And I thought, let's talk about them and let's apply them to, everything I talk about in this podcast and the Australian investing landscape to help people, get a better insight, I guess. And it's very much, it's a perfect segue into sort of Wealth by Design because it's exactly that approach. Come up with 8 fundamental rules that you can stick by because building wealth isn't really an information problem. It's typically a behavioral and process problem. So what is the process I need to go through and can I stick to that plan? And using evidence-based rules, consistently over many decades beats investing off the back of opinion any day. And using checklists, like pilots do, using checklists is really a great way of staying on track and avoiding making costly mistakes. So probably people are very familiar with Charlie Munger. It's Warren Buffett's business partner. He was a billionaire when he passed away a couple of years ago, I think, and had a lot of wisdom that wasn't limited to investing. So a lot of wisdom even just in life and so forth. I really enjoy a lot of what Charlie says. But anyway, he came up with this list of 10 investment principles. And what I wanted to do today is just talk about each of them. Okay, so investment rule number 1. Risk, start with the downside. So what Munger was saying here is the first thing of every investment evaluation should be measuring risk. What can go wrong? And it really is great advice because I guess we're bombarded with lots of different investment opportunities on social media, talking to friends, talking to other professionals, whether it's buy a regional property in a self-managed super fund, buy off the plan or new builds for negative gearing benefits, buy a property with rental guarantees or this private credit fund or this ETF that has this very attractive investment thematic. And every one of those investment opportunities carries downsides, which are almost never marketed, almost never really talked about. So instead, what people talk about is potential upside, first and foremost. Of course, they're selling the idea or they're marketing, whatever they're marketing. You should be blind to that. And the first thing you need to ask yourself is, what can go wrong? And the reality is that every investment has risk, and some of those risks are absolutely remote. So it's not about finding investment that has zero risk. Every investment has some risk, but by taking an evidence-based approach and really being prudent and unemotional about it, and completing a pre-mortem on the investment is really the best way to avoid making mistakes. And if you end up saying no 19 out of 20 times, or even 99 out of 100 times, so be it. That's not necessarily a bad thing, and it's what certainly Buffett and Munger have said a number of times. They say no a lot more often than they say yes, and they're happy to sit there and say no for many, many years, and they have the discipline to ignore the little voice in the back of our head saying we're missing opportunities, we need to make some decisions, we should just make the investment, all that sort of stuff going on in the back of our head that happens to all of us. They ignore that because they're really focused on risk, and it's no surprise that that's rule number one. Rule number two is independence. Stop borrowing other people's conviction. And that works in two ways. Independence in terms of avoiding conflicted advice. Buyer's agents will obviously promote property over shares. They will sometimes promote projected returns or various investment strategies. Active fund managers or stockbrokers will often promote shares over property, of course, or they all have compelling theses around why they're picking particular stocks and why their past performance will persist. Industry funds promote that they're only there to serve members because they're not there for a profit. That should result in better outcomes for you. I mean, you can question whether that's true. I would say any business that's for productivity and better outcomes is probably better than, just saying we're not for profit. But there's a lot of conflict that goes on within financial services and also other investment markets. Much of it is obvious, but some of it isn't, and that's where we can really fall down. The other thing as well, the other part of the independence equation is to really separate positive sentiment and momentum from fundamentals. So, there's been a lot on social media about buying small sales commercial property, and I'll have a podcast episode on that next month. A lot about, fully franked dividend income, so investing for franked dividends, believing that the Australian market is inherently safe. Buying blue chip stocks in Australia is the safe way to go about it because they're paying high dividends but deliver very little growth. These investment ideas tend to be other people's ideas, and it's easy to adopt these ideas with and borrow their conviction on it. And really, at the end of the day, we've got to approach really everything, including everything I say in this podcast, with a healthy level of skepticism, with trying to look to see if there is any bias. And sometimes the bias isn't intentional. Sometimes it's from experience, sometimes it's part of a person's business model, but sometimes there's bias. So where is the evidence that demonstrates what this person is saying is true? Because we can typically trust the evidence if the data is reliable, of course. But if there's no evidence, then what we're doing is we're investing based on opinion or what's popular or what's had momentum over the more recent history. Whereas if we ground our decisions in sound evidence-based fundamentals, then we have a much higher probability of sticking with that investment strategy for long run. And if we inevitably deal with some volatility, like a 30% share market drop, we will take it in our stride if that original decision had a fundamentally sound, high conviction approach. Rule number 3 is preparation is the only edge available to most investors. So Munger says the only way to win is work, 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 and hope for a few insights, unquote. Really, the idea here, and it's probably lost on people that are listening to this podcast episode because you're already doing it. The reality is that you don't need to become a technical expert. If you've got a financial advisor, they're going to, know a lot more about financial planning, tax, lending, superannuation, investing than you will ever know. And they've got, most importantly, a lot more experience in applying those concepts over time in different markets. And so it's important to lean on good advisors for very important decisions. But you need to have enough knowledge to ask good questions, to test assumptions, and to recognize when something doesn't sound right. The reality is that that most financial concepts are rooted in either basic math or just general logic. And for that reason, they can be explained simply, I believe. So there's nothing that's out there that's so complex that can't really be explained simply. So that means you don't need to have a natural flair for financial advice or investing or tax or super or property or whatever it might be. And you don't need to become your own advisor. You just need to become an informed decision maker. And that preparation to have the basics, to know the basics, will really set you in great stead. And if you're venturing into a new area of investing, that's really the place to start, in my opinion, because without that sort of basic knowledge, it's going to be really difficult to comply with rule number one, which is to assess risk before you assess future returns. Okay, rule number 4 is maintain intellectual humility. I think this is really one of the big rules that I certainly live by. And I like the saying, hold strong opinions loosely. So, hold strong opinions, have conviction in your opinions, but hold them loosely. Don't be so arrogant that you think, your viewpoint is right and that your viewpoint will continue to be right over the coming years and decades. You've got to leave room for the possibility that you could be wrong. And arrogance, I think, is the worst trait an investment advisor can actually have, because they'll be blindsided one day if they're so arrogant that they know everything, that they're right, that the way that they've been doing it for the last 10, 20 years, 50 years, whatever it is always going to work. Then it's only a matter of time until something changes in the market or something changes in the rules of the game, and they will be blindsided because they'll be caught out because they'll never see it because they're not looking for it. And so as an advisor myself, I'm constantly asking myself, what don't I know? Is this still right? I like to read commentary that is kind of contrary to my belief, I'll read it and it might keep testing that belief, and over time my belief might change, or it might actually give me stronger conviction, that what I believe is right. But the point is, we have to stay humble, and we as advisors must leave room for the possibility that we're wrong and not become so arrogant we've got one way to do things. And it's true from a client side too. I mean, we can come across some very successful, very smart people, but just because you're successful and smart in your profession, that doesn't necessarily make you an investment expert. And also, just because of the approach that you use in your profession doesn't necessarily mean you should use the same approach towards making investment decisions as well. We've seen some intellectually very smart people make some not so great investment decisions. And so really, humility, I think, is your greatest advantage as an investor. Rule number 5 is analytical rigour. Use the scientific method, not stories. And this is right in my wheelhouse. As you can imagine, I talk about an evidence-based approach. Whenever I approach topics, I always go to the numbers and the modeling and the analysis and looking at past returns and past performance and considering, the landscape in the future, whether that performance is repeatable. This is all the things that Charlie Munger was talking about. In the short run, sentiment and investment themes, they all sound very compelling. And by definition, of course they sound compelling, otherwise they wouldn't be successful and people wouldn't be putting a lot of money behind it. But at the end of the day, investing with evidence-based fundamentals ultimately is going to help you avoid making a lot of silly, emotional, short-term based mistakes. So of course that's low-cost, evidence-based, rules-based index investing using ETFs or other managed funds. For property, it's all about established locations, structurally sound, demand and supply. Of course, we need to think about what might happen as a result of the federal budget changes. But, taxation will change from time to time. So even if those federal budget measures go through, it's possible maybe for the next couple of years investing in property is no longer attractive, but taxation regimes move around. I'm sure it will return. I just don't know when, but I'm sure negative gearing will return, or at least there'll be some, either it won't be enacted as proposed because it's way too harsh and it will have too many negative consequences. And whilst it may raise some tax revenue, it will certainly disadvantage younger people. So I think it's going to change, whether it'll enacted and then it'll be changed in a couple of years' time, or whether it will never become law, who knows. But the way to build wealth won't change. And, the tax settings will one day accommodate investing in established property. And that analytical rigor is important. It's important also on the taxation side, right? So we can't be blinded and say, no, let's just keep buying property. Who cares about the tax? If the tax is considerable and has a considerable impact, and negative gearing does, CGT to a much lesser extent, then we need to listen to those numbers. So analytical rigor is, as I said, right in my wheelhouse as rule number 5. And rule number 6 is, probably equally in my wheelhouse. I've written about this a lot. Allocation is an investor's number one job. And I couldn't agree more. We as advisors cannot control markets. We cannot control sequence of returns. We cannot predict which asset class is going to perform the best over the next 1 to 2 years. And the reality is that no one in the world has developed a reliable and consistent way of predicting those things. So our starting assumption should be, we have no idea. Therefore, the only thing we can control is the allocation of capital. So where are we going to invest our monies? Are we going to put them all in one asset class or one investment? Are we going to spread them across multiple investments? Yes, that's probably the better approach. And how are we going to do that? What investment methodology are we going to use? What products are we going to use? What platform are we going to use? They're the key important decisions that are ultimately going to determine your long-term returns. Now, what the returns might be in the short term, nobody knows and no one can control. But what we can control is there really attractive parts of the market? And will we look back in 10 years' time going, well, that was obviously cheap? With the benefit of 2020 vision, we can see now back in 2026, that market was cheap, or that asset was cheap, or that suburb or capital city was cheap. And they're the decisions, they're the reflections that we hope to avoid, so that we really think carefully how we're allocating capital and what investment methodology we're using, because we've got 100% control on those factors. What we can't control is all the rest. What will happen in the short term, but what will happen in the longer term should be, by definition, a lot more predictable. And that's why Munger's rule number 6 is really about allocation, and that's really where you as an investor should really spend most of your time. Okay, rule number 7 is patience. The human bias to act is the enemy of future returns. It really is. It's a really interesting human behavioral sort of situation. I think in most situations, maybe 8 out of 10 situations, the best response is to do nothing. And, to some clients, doing nothing feels like we're sitting on our hands, that we're not making a decision. But actually, the decision to do nothing is, in fact, a deliberate decision. So that in itself is actually doing something, believe it or not, but it doesn't feel like it. The problem is when there's stimulus, when there's something that changes, we feel like we need to change something or we need to react. And we also feel like, well, in the face of that change, if we don't react, are we going to look stupid? Is it stupid not to react? And these are natural feelings, of course, natural emotions. And they're hard to ignore, but that's one of the best things or biggest values, I guess, of being a financial advisor in a client's life, is you can prevent a client from making a decision. Something's changing. I think we should do this. We'll say, no, we absolutely should not. Stick to the plan, stick to the investments. They're fundamentally sound, write it out. And in 5 to 10 years' time, you look back and go, well, thank God we did that. And there's a lot of value in that, I think. The reality is that the returns are going to come probably in the last decade of owning an asset. If I buy an investment property, I've spoken about compounding capital growth previously, or an ETF. In the first 10 years, the results aren't that exciting necessarily. In the next 10 years, so years 11 to 20, they're exciting. And after 20 years of owning an investment, holding that investment through many periods, as long as it's fundamentally sound, that's when the returns start to become exponential and they start to become almost hard to relate to. And patience is not inaction. In fact, it's a competitive advantage as an investor. And it's something that Warren Buffett and Charlie Munger have exhibited certainly over many, many decades. They're happy to sit on a whole bunch of cash, even when technology and AI and all this, the returns are pretty extraordinary. They're happy to sit on cash and just wait for a good investment opportunity. As I said, you look at last 50 years, it certainly serves them really well. Now, at the same time, patience is important. Rule number 8 is about decisiveness. So when the setup is clear, act. When it's the right time to make an investment, make that decision and act. And procrastination can be a terrible waster of, financial opportunities. And it's something that, we've seen over the years. But, I've changed my approach, certainly in business over the last 10 years. We work with, in terms of describing our clients, we work with clients that are motivated to build wealth. We don't motivate people to build wealth. So if you come to us and you're not motivated to actually take action and build wealth, you're not the client for us. It's impossible. I've given up trying to, motivate people. So ultimately that motivation needs to come internally. But I think it's also really important to know when is patience, when is it the right time to do nothing, but also to recognize when the right time is to do something. And I guess there's probably two common situations that we come across that are really obvious. The first one is when share markets fall. So we always tell clients, I certainly have conversations myself with clients, say, look, for now, we're happy to go slow and steady. We're going to invest a little bit each month and we'll build out this portfolio. But just to let you know, if the market was to drop 30% tomorrow, I'm going to come to you and I'm going to say, we're going to invest aggressively. And whilst that might sound fine to you in the cold light of day, as we're talking today, the backdrop won't be like that. The backdrop will be full of uncertainty, full of risk, and it will feel like the last thing you want to do. So I'm just going to tell you now that that's going to be the circumstances. Of course, we're not going to force you to do anything you don't want to do, but that is the time to act. And, that's so that I will say that to clients just to really pre-prepare them. And, we'll probably still have another conversation when it is time to invest after a 30% drop, but you've got to know when to act and when to have that decisiveness to invest. The other common one is probably big property decisions, whether it's to upgrade a home, make a really large investment instead of a couple of smaller individual investments. But if the evidence is clear in terms of it's affordable, it's the right strategy, the value proposition is right in terms of we're buying a good quality asset for a fair or attractive price, then we need to know when to hit the button and do that. Similarly, it could be that situation where there's just too much risk and we would say, no, wait, don't do anything. But it's really knowing when to hold them, knowing when to fold them. If I use that old sort of Kenny Rogers song lyrics, it very much plays true. And certainly that's rule number 7 and number 8, according to Charlie Munger. Okay, rule number 9 is all about change. Accept the complexity you cannot remove. So really it's about worrying about the things or putting your attention towards the things that you cannot change and just accept the ones that you can't change. And complexity such as, the world's not stable. We've got the Iran war. We've got tariffs in the US. We've had financial crises. We've had European debt issues in Greece and Italy, many years ago. We've got tax rule changes potentially coming across. We've got changes in interest rate cycles, and certainly they've changed a lot over the last couple of years. In Australia, you've got state governments tightening tenancy laws and lifting land tax rates, doing these sorts of things. And there's always something changing, and that complexity and risk you cannot remove from markets. So all you can do then is design a plan that really accommodates or navigates that risk, that a plan that's robust even in the face of these changes, which really means diversification across multiple asset classes in terms of property and shares, across geographies, across ownership structures, being very careful to avoid borrowing too much, but also avoid under borrowing, avoid concentration risk, which I've spoken about more recently, holding cash buffers and really reviewing your plan periodically. So we can build into a strategy and make a strategy as robust as possible to many of these changes. And that's all you can do. And then you don't need to worry about the changes. You just need to stick to your plan, stick to the evidence-based fundamentals, put one foot in front of each other. And if you keep doing that year after year, after a couple of decades, you will be absolutely surprised at the results. Okay, the 10th and final rule is focus, keep it simple, and remember why you started. You started investing so that you can have the flexibility to reduce working hours at some age and stage of life, either to zero or gradually reduce it and transition into retirement. And I talk about this a lot. And in fact, it's rule number 1 in Investopoly, which is play the long game. Investing, the main goal of investing is really to maximize investment returns on an after-tax basis, or really to build the greatest amount or the required amount of assets after tax in dollar terms. So percentages are good, but ultimately, hopefully what we do is we work hard, invest hard, and hopefully end up with, 3 or 4, 5 million, whatever it might be, dollars after tax in our pocket that we can go and spend in retirement. Our goal's not to avoid volatility or risk, not to avoid bad years or bad periods, not to avoid inevitable challenges that come our way, taxation changes in interest rates, pressure on cash flows. It's really staying focused to that very long-term outcome. Over the next 10, 20, 30, 40 years, I want the highest average return for the lowest risk. And when you focus on long-term outcomes, you naturally focus on the things that matter. Asset quality, the starting valuation. So I spoke recently about a value-aware asset allocation, diversification, leverage, cash flow, taxation, of course, costs, and ultimately remaining invested for as long as possible. And in the earlier years, it feels like you're not really making much headway. Most of the returns come from the capital that you've invested rather than income or compounding returns. But again, do it after a decade, it'll really start to see the results. And certainly after 20 years, you will be amazed at the results. So remaining focused on that long-term outcome really does help you focus on fundamentals and therefore avoid making very costly mistakes. And so the common themes across these 10 rules are really preparation, discipline, patience, and decisiveness. And I think these rules really summarize a lot of what I talk about here at Investopoly. Very much sort of summarize and fit nicely within Wealth by Design and also what I talked about in Investopoly. But it serves as a very, very useful checklist for us to remind ourselves of. And, it certainly wouldn't be a waste of time to, go back over these 10 rules every 6 to 12 months, particularly in periods where you're making a lot of investment decisions or there's a lot of stimulus to, promote you to or entice you to make investment decisions. Coming back to these rules, some form of checklist will certainly be a valuable tool to help you, not make any silly decisions, not to overreact, but also not to miss the boat either when it is time to make some decisions. Okay, so just as a reminder, there's a link in the show notes to pre-order my book. If you could do that, that would be so wonderful. I would really appreciate it. Certainly, I think you'll get a lot of value, hopefully, out of Wealth by Design, particularly around the Notebook LM tool. I think it's really, I don't want to overplay it. I think it's a bit of a game changer. I think AI is a game changer. Of course, I'm not sticking my head out by saying that, but I think, help people get a lot more value out of the book. So I think there's a benefit there for you. But, if you've enjoyed the podcast, one way you can support me is getting those pre-order numbers up because it will certainly help me sell into bookstores. And the whole point of writing a book is not book sales. That's not going to change my life. I don't be arrogant about it. I'm very appreciative, of course, but it's ultimately not really going to change anything for me. It's really about the more people that read the book, the more value, hopefully, that they will enjoy, and the better I will feel about locking myself away in my office at home for months on end writing this thing. So thanks very much for listening today, and thank you for the support that you all give me on this podcast. I really do appreciate it. I do put a lot of energy and thought into the topics that I talk about each week and the questions that I answer on Tuesday, but also I appreciate that, that effort is often acknowledged by my listeners. So thank you. I'll leave it there today. Next week, I'm going to talk about investing all your super in an internally geared diversified ETF. So I had this question on YouTube, which is a great question, and I wanted to do some analysis on it. Pretty interesting. I thought it was an interesting topic anyway. So that's next week. I can't believe we'll be into June already. And also in June, I'm going to talk about investing in commercial property and why I don't think it's particularly attractive at the moment. So I'm looking forward to pulling that episode together as well. So until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.